If you want to know what the pharmaceutical industry is going to look like in, say, 2036, you actually shouldn't be looking at the clinical pipelines of Pfizer or Moderna today.
Right, because that's just looking at the end product.
Exactly. You have to look at the plumbing. You need to look at a 280 basis point drop in profit margins for a company that, breeds lab mice, runs toxicology tests, and basically acts as the gatekeeper for almost every single drug trying to get FDA approval.
Yeah, the real leading indicators.
So welcome to a brand new deep dive. Today, we have a massive stack of sources centered around a single, highly revealing document. And that is the Charles River Laboratories Q1 2026 earnings call transcript.
And this is such a crucial document.
It really is. For you listening, whether you're holding a position in biotech, managing a healthcare portfolio, or honestly just trying to figure out how a brand new molecule actually makes it from a computer screen into your local pharmacy, this transcript is your crystal ball.
Oh, 100%. Because we're looking at Charles River, which trades under the ticker symbol CRL, not just as a standalone business. We're using it as the diagnostic blood work for the entire global life sciences ecosystem.
I love that analogy.
Well, it's true. I mean, an earnings call for a primary research partner like Charles River, it gives you a vantage point you just cannot get from a traditional pharma earnings report.
Because pharma is lagging.
Exactly. When a massive pharmaceutical conglomerate reports their earnings, you are looking at the commercial success of drugs that were conceptualized 10 years ago. It's a trailing indicator.
Right.
But Charles River's order book, their margin compression, their strategic divestitures, all of that tells us exactly what kind of capital is flowing into early stage R&D right this very second.
And looking at this Q1 2026 transcript, we are seeing a landscape that is defined by aggressive corporate restructuring, right? And a heavily constrained venture capital environment for those seed stage startups.
Yeah, and a massive structural pivot to internalize volatile supply chains, which is fascinating.
Oh, it really is. But we have to start with the people steering the ship here, because you don't get these kinds of aggressive strategic shifts without a changing of the guard.
No, you definitely don't.
Right. So looking through the call, Birgit Gershick is now at the helm as Chief Executive Officer. She's taking over from Jim Foster.
And Foster is essentially a legacy builder in this space. I mean, he built Charles River into the behemoth it is today over decades.
Yeah, and succeeding a founder-like figure is notoriously treacherous in corporate America.
It's basically a tightrope walk.
Right. And she's flanked by a new CFO, Glenn Coleman, who is a veteran. He's managed the books for multiple public healthcare companies. So, right out of the gate, Birgit introduces this new strategic framework, and she's calling it Pathway to Purpose.
Which she breaks down into three main pillars on the call.
Okay, let's unpack this. What are the pillars?
So it's modernizing the company to be agile and data-driven, strengthening their scientific portfolio, and shifting to a highly customized, client-centric model.
I read that and immediately raised an eyebrow.
Oh, you thought it was buzzword bingo.
I mean, Pathway to Purpose sounds exactly like the kind of sanitized corporate jargon designed to mask a brutal reduction in force.
Yeah, I hear you.
Right. Like when a new CEO and a veteran Axeman CFO take over a legacy company and start talking about modernizing and agility, that usually just translates to gutting the operational footprint to temporarily prop up margins.
It's a fair suspicion.
So I have to ask, is there actual structural innovation happening here, or is this just standard cost cutting under a shiny new brand?
Well, it is undeniably a cost-cutting mandate. Let's be clear about that. But characterizing it merely as a superficial margin prop, I think that ignores the real technological overhaul they are attempting.
Okay, walk me through that.
So when leadership transitions occur at these legacy infrastructure companies, it provides a crucial honeymoon period.
Like a window to do the dirty work.
Exactly. To surgically remove redundancies that just sort of accumulated during periods of rapid, unchecked expansion, like the COVID-19 biotech boom, for instance.
Everybody overhired during COVID.
Yeah, right. So Birgit is targeting $100 million in incremental cost savings this year alone, and that's building on over $300 million in annualized savings from past actions.
Wow.
Yeah. So finding $400 million in total annualized savings, that isn't just trimming the fat. That requires fundamentally altering how the company delivers its services.
I mean, 400 million means you are tearing out the copper wire and replacing it with fiber optics.
Yeah.
How are they executing that mechanistically?
A prime example is their Apollo cloud-based platform.
Which is their digital portal, right?
Yeah. Historically, designing a safety assessment study, pricing it out, managing all those client interactions, that required massive amounts of human capital. It was iterative, manual, and just slow.
A lot of emails and spreadsheets.
Exactly. Apollo automates that interface. When biopharma clients can just use a self-service digital portal for real-time scientific data and study design, Charles River dramatically reduces its SG&A, their selling, general, and administrative expenses.
Which hits the bottom line immediately.
Right. And they are simultaneously consolidating physical sites within their discovery business. So, yes, it involves layoffs and facility closures, but it's done to permanently lower the baseline operating costs.
Especially in an inflationary environment where, let's be honest, top-line revenue is pretty stagnant.
Exactly. You have to protect the margins when the top line isn't moving.
Which brings us perfectly to the financial reality of Q1. Let's dig into those headline numbers because that stagnation is glaring.
Yeah, the Q1 print was definitely a mixed bag.
So revenue came in at $996 million. That's an organic decline of 1.5%.
And this is but Wall Street actually reacted relatively well to that revenue contraction.
Because the expectation was significantly bleaker.
Much bleaker.
And then you look at non-GAAP EPS, earnings per share. That was $2.06, which is a 12% decline year over year.
But again, management made sure to point out that this beat their own internal forecasts. They were bracing for a high teens decline.
Ah, the classic earnings game. You lower the bar so much that tripping over it looks like a victory leap.
I mean, beating depressed expectations is a reliable way to stabilize a stock. But the deeper metric that you really need to analyze here is that profit margin.
This is where it gets ugly.
Yeah. The non-GAAP operating margin compressed by 280 basis points. It landed at 16.3%.
A 2.8% hit to operating margins is a massive bleed for a business like this.
It is.
So Glenn Coleman, the CFO, he spent a considerable amount of time explaining the discrete headwinds driving that compression.
Right. He had three main culprits.
Yeah, he points to higher stock compensation expenses tied to the CEO transition, increased sourcing costs for non-human primates, and shipment timing delays within their animal model segment.
Which all sound like one-off issues.
But I have to push back here. Blaming margin compression on CEO transition packages and shipping delays, it just feels like a convenient way to obscure structural pricing power issues.
You think clients are negotiating them down?
Well, yeah. Are clients simply refusing to pay premium prices in this macro environment? Are they being squeezed?
It's a fair question, but what's fascinating here is that the data actually doesn't support a loss of pricing power.
Really?
Yeah. Coleman's explanation holds weight because those specific headwinds are demonstrably discrete and mathematically quantifiable.
Okay. Break that down for me.
Well, the stock compensation for a CEO transition, that's a one-time structural event. It won't repeat next year.
Sure.
And the shipment timing issues with the animal models, that represents deferred revenue, not lost revenue. The animals will ship, they'll just recognize the money in Q2.
So just shifted to the right on the calendar.
Exactly. Investors and analysts, they'll accept a 280 basis point margin drop if the CFO can draw a direct, undeniable line between external, temporary friction and the balance sheet.
And you don't think pricing power is slipping at all?
If biopharma clients were negotiating prices down, you would see it reflected in a shrinking backlog and deteriorating booking metrics. But we saw the exact opposite of that in the discovery and safety assessment segment.
Okay, that leads us directly into the segment breakdown then. Let's look at where the money is actually flowing.
Yeah, we have to look under the hood.
Starting with that massive DSA engine, discovery and safety assessment, they brought in $597 million.
Which, to be fair, is a 1.4% organic decline.
It is, but the vital sign for the future, and this goes to your point about pricing power, is the net book-to-bill ratio. That came in at 1.04x, generating $622 million in net bookings.
And for anyone listening who is tracking the macroeconomic health of the life sciences sector, a 1.04x book-to-bill ratio in the current high interest rate environment is a profoundly bullish signal.
Okay, let's contextualize that for the retail investor. Why is that number so critical?
Well, in a zero interest rate phenomenon, booking more contracts than you are currently billing is completely expected.
Because capital is cheap, right?
Exactly. Capital is free, so biotechs throw money at future pipeline development. But when capital is this expensive, a ratio over 1.0 means clients are committing scarce, highly scrutinized dollars to future safety and toxicology testing.
So they aren't just keeping the lights on, they are aggressively loading the pipeline.
Precisely. And it builds this formidable safety net for Charles River. Their backlog now sits at $1.92 billion.
Almost $2 billion.
That represents nearly $2 billion of contracted, highly regulated scientific testing that is just waiting to be executed.
So even if the broader biopharma funding market completely froze tomorrow, Charles River has immense forward visibility.
They could coast on that backlog for quite a while.
But safety assessment is only one piece of the puzzle. We also have the Research Models and Services segment, RMS.
Which had a tougher quarter.
Yeah, they reported $208 million in revenue, which is a much steeper organic decline of 5.5%.
And management attributed this mostly to sluggish demand for small models in North America, plus those shipping delays we talked about.
Right, but Birgit highlighted a highly localized anomaly here that I found fascinating. She noted robust demand for small models from CROs and mid-tier biotechs in China.
Which runs completely counter to the prevailing narrative right now.
Exactly. Here's where it gets really interesting. We constantly hear about U.S.-China trade friction, tariffs on medical supplies, geopolitical decoupling, capital flight from Chinese markets.
It's all doom and gloom in the macro headlines.
Yet Charles River is witnessing a localized boom in research demand over there. How did that make sense?
Well, scientific advancement operates on a totally different mandate than traditional macroeconomic cycles. China is aggressively establishing its domestic biopharma infrastructure.
Right. They want to be self-sufficient.
They are transitioning from being a generic drug manufacturer to being a primary innovator in biologics and advanced therapies. So they need the research models.
Even with all the geopolitical noise.
Exactly. And while the RMS China business constitutes less than 5% of Charles River's overall revenue, maintaining that foothold is strategically vital.
Because it's a massive growth market.
It gives them direct access to an accelerating market, and it provides a hedge against North American sluggishness.
Okay, then you look at the third pillar, manufacturing. And this was the undisputed standout of the quarter.
Oh, absolutely.
Revenue hit $191 million. That's a 2.9% organic increase. And it was driven entirely by demand for their microbial solutions like the EndoSafe and Celsis testing platforms.
And look at the margins there.
Yes, the operating margin in this segment exploded by 280 basis points to nearly 26%.
Which is incredible. So the manufacturing segment, for context, represents the tail end of the drug pipeline commercial quality control.
So this is for drugs already on the market.
Exactly. EndoSafe, for instance, is utilized to ensure manufactured drug batches are free of endotoxins before they are injected into human patients.
Kind of important.
Very important. The fact that this segment is experiencing high margin growth indicates that while early stage research might have faced bottlenecks last year, late stage commercial manufacturing is operating at full capacity.
They can't skip on that.
No, biopharma companies will not cut corners on commercial release testing. It is completely non-negotiable from a regulatory standpoint.
It's a brilliant structural hedge when you think about it. If venture capital dries up and early stage discovery stalls, the DSA segment might feel the pinch.
Right.
But the drugs that are already approved and commercialized, they still need to be tested by the manufacturing segment every single day.
It buffers the company against the inevitable volatility of the drug development lifecycle. But, the segment breakdown also reveals a shift in biopharma behavior across the board.
Yeah, management spent a lot of time addressing the broader demand environment.
Because Charles River is the ultimate biotech barometer.
Right. Birgit noted that while things stabilized generally in 2025, the recovery in 2026 is highly fragmented.
Very fragmented. Let's dissect that, because she noted that large pharma clients have largely concluded those brutal pipeline reprioritizations we saw when interest rates first spiked.
The era of cutting everything that wasn't a sure thing.
Exactly. They've trimmed the fat, and now they are actively pushing more programs toward IND status.
And for you listening, securing an investigational new drug application, an IND, that is the ultimate regulatory gateway. You literally cannot put a molecule into a human being without it.
And you cannot get an IND without exhaustive preclinical toxicology data.
Which Charles River provides.
Right. So if large pharma is accelerating their IND submissions, the volume of requisite safety testing flowing into Charles River's DSA segment is going to surge.
That's the bullish case for large pharma.
Yeah.
But the dynamic within the smaller biotech space is far more precarious, isn't it?
Much more. The transcript paints a really bifurcated picture of biotech funding right now.
Yeah, we are seeing a rebound in IPOs and capital infusions via M&A for mature clinical stage biotechs. But Birgit specifically described the seed stage funding environment as, quote, constrained.
The venture capital is flowing, sure, but it's entirely risk averse.
They want a sure thing.
Capital allocators are demanding a clear line of sight to clinical data. They're willing to fund a Series B or Series C for a molecule that has already cleared those early hurdles.
But two scientists with a whiteboard.
Exactly. Backing a pair of scientists with a novel mechanism of action at the seed stage is currently viewed as way too speculative. So that limits the volume of brand new molecular entities entering the very top of the discovery funnel.
Now, there was a detail surrounding client behavior on the call that I found incredibly revealing. An analyst inquired about the velocity of decision-making.
The conversion rates.
Yes. Birgit noted a dramatic shift in conversion rates. During the pandemic, clients were hoarding lab capacity. They were booking studies 2 years in advance just to secure a slot.
Because capacity was so tight.
Right. But now, she says, discussions frequently move from initial proposal to recognized revenue within a single quarter.
A huge shift.
So does faster conversion mean the industry is finally healing from the pandemic supply chain hangover? Because some might look at that rapid turnaround and assume the industry is just desperate, operating hand to mouth.
If we connect this to the bigger picture, that interpretation fundamentally misunderstands the nature of backlog risk.
How so?
Well, the 2-year forward bookings during the pandemic, that was phantom backlog.
Phantom backlog.
Yeah, if a client books a slot for 2026 back in 2024, there is an incredibly high probability that their candidate fails early toxicity screens or their funding round collapses, and that results in a canceled contract.
So it's basically just a placeholder that might evaporate.
Exactly. A rapid conversion rate, on the other hand, implies absolute conviction. If a client requests a proposal and signs the contract a month later, it means the molecule is already synthesized, the capital is sitting right there in their treasury, and they are prepared to execute real science immediately.
That makes total sense. So faster velocity translates to a higher quality, lower risk backlog for Charles River.
Precisely. But there's a catch.
What's the catch?
Rapid conversion requires Charles River to have immediate, unconstrained physical capacity to actually execute those studies. You cannot convert a proposal to revenue in a single quarter if you don't possess the necessary resources on hand.
You need the lab space, you need the animals, you need the scientists.
Exactly. And this imperative brings us to the most aggressive strategic maneuvers discussed on the call, which is their M&A and divestiture strategy.
Yes, the strategic surgery. Charles River is fundamentally reshaping its asset base to capture this returning demand.
They are not sitting still.
No, they're not. On the divestiture side, they finalized the sale of their CDMO, that's the Contract Development and Manufacturing Organization, and their cell solutions businesses in early May.
Plus, they are actively shopping certain European discovery sites.
Right. Divesting a CDMO is a massive, deliberate retreat from heavy manufacturing.
It's a huge pivot. Operating a CDMO requires immense, continuous capital expenditure just to maintain the physical plants and the bioreactors.
It's extremely capital intensive.
Exactly. By shedding this business, Charles River is signaling a strategic exit from the low-margin business of physically compounding chemicals.
It's highly analogous to the evolution of a major tech company.
How do you mean?
Think about Apple. A while ago, they decided they no longer wanted to deal with the logistical nightmare and the low margins of physically assembling iPhones in massive factories.
Right, so they outsource it.
Exactly. They outsource the assembly and focus entirely on designing the high-margin iOS software and the proprietary silicon. Charles River is dumping the heavy manufacturing to exclusively own the high-margin, highly regulated testing data.
That's a great comparison. And they are redeploying the capital generated from those divestitures to fortify their most critical vulnerability.
Which brings us to the acquisitions of KF Cambodia and the controlling stake in Novoprim.
The non-human primate strategy.
Yes, the NHP strategy.
Yeah.
And this is arguably the most critical defensive move they have made in a decade.
Absolutely.
For you listening, we need to understand the absolute necessity of NHPs in this space. The FDA mandates non-human primate testing for the vast majority of complex biologics and advanced therapies before they can enter human trials.
There's no getting around it right now.
Right. But over the past few years, the global supply chain for these animals has been totally fractured. We've seen export bans, disease outbreaks, intense geopolitical friction, particularly concerning exports out of China.
It's been a nightmare for CROs. Historically, Charles River relied on third-party vendors, or they managed external supply obligations through farms in places like Mauritius.
But now, by acquiring KF Cambodia and Novoprim, they are internalizing the supply chain.
Birgit explicitly stated on the call that they intend to internally source the vast majority of their future NHP requirements.
Okay, I have to challenge the long-term viability of this.
Really? Why?
Because vertically integrating agricultural assets, which is essentially what a primate breeding facility is, it introduces massive operational liabilities.
Well, there's agricultural risk, sure.
Massive risk. If there is an infectious disease outbreak at that Cambodian facility, or a sudden shift in local export regulations, Charles River's entire competitive moat evaporates overnight.
That's the bear case, yeah.
Right, they won't have the animals to run the tests, and the DSA segment will just grind to a halt. Doesn't internalizing the supply chain just concentrate their risks, like a massive restaurant deciding to stop outside catering and instead buying the actual farms that supply their ingredients?
It does concentrate agricultural risk, undeniable. But consider the alternative.
Which is the spot markets.
Exactly.
Well,
Relying on the spot market for NHPs over the last 3 years resulted in crippling price volatility and an absolute inability to guarantee study timelines for clients.
you literally couldn't tell a client when their study would start.
Right. When you own the supply, you eliminate the vendor markups, and you insulate your margins from sudden global supply shocks.
You take control of your own destiny.
Yes, you assume the operational risk of managing the facilities, but in the highly regulated biopharma ecosystem, controlling your own supply of an indispensable resource is the ultimate leverage.
So it's a power play.
Totally. Think about it. If a mid-tier biotech needs to initiate a critical safety study and Charles River has guaranteed internal animal supply while a competitor is scrambling to procure models on the open market,
Charles River commands the pricing power and wins the contract.
every time.
Every single time. It creates a closed loop. They control the start of the study through the supply, and they control the end of the study through the proprietary testing data.
It's brilliant.
But while they are spending capital to secure the physical reality of wet lab testing today, the transcript also reveals this deep focus on future-proofing.
Because the industry is changing.
Rapidly, they are preparing for a world that increasingly views animal testing as an archaic bottleneck. The scientific landscape is moving toward algorithms and in vitro models, and Charles River is aggressively buying into NAMs.
NM's new approach methodologies.
Exactly.
And the acquisition of PathAquest in April is a prime example of this pivot.
Right, PathAquest. They utilize in vitro next-generation sequencing for the quality control testing of biologic drugs. Let's break down the mechanics of that because the contrast with traditional methods is pretty stark.
Oh, it's night and day. Historically, to ensure a biologic drug wasn't contaminated with a latent virus, you might have to utilize an in vivo test.
Which means using a live animal.
Right. Injecting the biologic into an animal model and waiting weeks to see if the animal develops a viral pathology.
Which is time-consuming, expensive, and obviously ethically fraught.
PathAquest bypasses the animal entirely. It utilizes advanced genetic sequencing to scan the biologic directly for viral DNA or RNA at a molecular level.
That's incredible.
It provides faster, more accurate data, accelerating the commercial release of the drug.
It's a clear evolution.
Yeah.
But Charles River is also leaning heavily into artificial intelligence with their AMP initiative.
The Alternative Methods Advancement Project.
Yes, and the centerpiece of this is their virtual control groups, or VCGs.
The mechanics of VCGs are just a brilliant application of legacy data.
I'll walk you through it.
So in the standard regulated toxicology study, statistical validity requires a test group receiving the experimental compound and a control group receiving a placebo, just to establish a baseline.
That's basic scientific method.
Right. But Charles River possesses decades of proprietary historical data detailing the precise biological parameters of healthy control animals across thousands and thousands of studies.
Because they've run more of these tests than anyone else on the planet.
Exactly. So instead of using live animals for the placebo arm, they utilize AI to synthesize that massive database. They generate a virtual control group that perfectly matches the physiological profile required for that specific study.
And the regulators are okay with this.
Independent scientific reviews have confirmed this maintains the rigorous statistical power the FDA demands while dramatically reducing the physical footprint of the trial.
It's a massive efficiency gain. Fewer animals, lower costs, faster setup.
It's a win all around.
But this brings us to the broader AI narrative that really dominated the Q&A portion of the call. Because, let's be honest, every executive on Wall Street is legally obligated to mention AI right now just to appease tech-obsessed investors.
Oh, it's a mandatory buzzword.
It is. And Silicon Valley venture capitalists are aggressively pitching this idea that generative AI will soon design molecules so perfectly that we can bypass wet lab testing entirely.
The in silico dream.
Right. We will just simulate the human body in a computer, prove the drug is safe algorithmically, and go straight to market. So is Charles River facing an existential threat from AI replacing their core business? Is all this wet lab testing just going to disappear?
This raises an important question, but Birgit addressed this directly on the call, and her response was thankfully devoid of the usual tech hyperbole.
What did she say?
She stated unequivocally that AI in drug development is an evolution, not a revolution.
Evolution, not revolution.
Yes. The critical flaw in the Silicon Valley thesis is regulatory reality. The FDA does not care how elegant your algorithm is.
They really don't.
They mandate physical, real-world validation of safety before a novel compound enters a human subject.
The regulatory framework is the ultimate moat. A computer simulation just cannot replicate the chaotic, cascading biological reactions of an intact mammalian system.
Not yet, anyway. So what AI is successfully doing right now is accelerating target identification and molecular design in the very earliest phases of discovery.
Right. Biopharma clients are deploying AI to screen millions of molecular structures, just to identify the most viable candidates faster and cheaper than human chemists ever could.
Which completely inverts the threat profile for Charles River.
Explain that.
Well, if AI drastically reduces the cost and time of early-stage discovery, pharmaceutical companies suddenly possess surplus capital and a massive influx of viable molecular candidates.
And every single one of those algorithmically generated candidates must be pushed through the regulatory gauntlet.
Exactly. AI isn't going to replace the regulated safety assessment. It is going to act as a massive funnel. It exponentially increases the volume of drugs arriving at Charles River's doorstep, requiring IND-enabling toxicology studies.
So AI is basically their best salesperson.
Pretty much. Birgit actually cited a Deloitte survey on the call, indicating that nearly 60% of biopharma R&D executives expect their AI investments to culminate in an increased volume of R&D approvals just due to this faster pace of discovery.
So Charles River is positioning itself to be the primary beneficiary of that increased volume.
Exactly.
Okay, so let's summarize where we are. We have a company actively divesting low-margin manufacturing. They are vertically integrating their critical animal supply chains to protect pricing power. And they are preparing their high-margin testing segments to absorb this impending wave of AI-discovered molecules.
That's the playbook.
So how does management translate all of this structural rewiring into financial guidance for the remainder of 2026? What is the roadmap ahead?
Well, management held the line on their core operational metrics. They reaffirmed their full-year organic revenue guidance, projecting a slight contraction between 0.5% and 1.5%.
Okay, slightly down but stable.
And they also maintained their non-GAAP EPS guidance of $10.80 to $11.30.
But I noticed in the transcript that their reported revenue guidance was adjusted downward. They're now projecting a 4.0% to 5.5% decline.
Right.
If operational metrics are holding steady, what is dragging that reported number down so much?
Purely macroeconomic friction. Specifically, foreign exchange headwinds.
The strong dollar.
Exactly. The U.S. dollar strengthened significantly. So for a multinational company like Charles River, revenue generated in Europe or Asia translates back into fewer U.S. dollars on the consolidated balance sheet.
This is an unavoidable accounting reality.
It is, and it completely obscures the underlying operational stability.
And Glenn Coleman highlighted that the negative impact of that strong dollar on their earnings per share is being systematically neutralized by their capital deployment strategy.
Yes, the buybacks.
Right. They executed $200 million in share repurchases in Q1 alone.
Which is a huge chunk of change.
It is. By aggressively shrinking the outstanding share count, they artificially inflate the earnings per share for the remaining equity holders, which creates this financial buffer against currency volatility.
It's financial engineering, but it works. But honestly, the most heavily scrutinized projection in the entire transcript was Coleman's guidance for the second half of the year.
The H2 step up.
Yeah. He stated that operating margins in the second half of 2026 will expand by over 500 basis points compared to the first half.
Okay, a 5% margin expansion for a multi-billion-dollar enterprise in a 6-month window borders on the absurd.
It's a massive, massive jump.
So what does this all mean? How does the CFO justify that kind of arithmetic without sounding completely detached from reality?
He justifies it by mapping the expansion directly back to all the structural surgeries we just discussed. Over half of that 500 basis point leap is mathematically guaranteed by the divestitures and acquisitions.
Okay, walk me through the math there.
By removing the dilutive margins of the CDMO business, the heavy manufacturing we talked about, and injecting the highly accretive margins of an internalized NHP supply chain via KF Cambodia, the overall corporate margin structurally elevates automatically.
So they essentially excise the lowest performing tissue and graft it on a high performing organ.
Exactly. It's structural. The remaining expansion is driven by the realization of the $100 million in aggressive cost-saving initiatives taking hold.
Right, the Apollo platform efficiencies and the layoffs.
Plus the natural expiration of the Q1 discrete headwinds.
So the CEO transition stock compensation won't repeat.
Right. And those delayed animal shipments, that deferred revenue will finally be recognized. So the math is actually highly visible. It's not magic, it's just mechanics.
It's just working through the system. So for you, the listener, looking at the totality of this transcript, the bottom line takeaway is profound. Charles River Laboratories is navigating 2026 not as a year of growth, but as a year of intense structural optimization.
They are essentially renovating the house while still living in it.
That's a perfect way to put it. The Q1 numbers appear sluggish on the surface because the company is absorbing the friction of a massive strategic pivot. They are ruthlessly cutting operational redundancies, abandoning capital-heavy manufacturing, and spending aggressively to own their critical supply chains.
And management's thesis is that by executing this pathway to purpose, they are essentially coiling a spring.
Getting ready to snap back.
Right. When the macroeconomic environment normalizes and the venture capital markets fully thaw, that $1.92 billion backlog will convert into revenue. And that revenue will flow through a fundamentally leaner, higher-margin corporate architecture.
They are building a fortress around the most profitable, highly regulated aspects of the biopharma ecosystem, positioning themselves as this absolutely indispensable gatekeeper.
A normalized environment in 2027 is going to look very, very profitable for them.
Absolutely. But before we conclude, I want to leave you with a perspective on the long-term implications of this strategy, particularly regarding the AI revolution we touched upon earlier.
Oh, this is the really fascinating part. The broader implications for the entire industry are immense.
We established that AI is going to widen the top of the discovery funnel, right?
Yeah.
It's generating thousands of novel, potentially life-saving molecules at a fraction of the historical cost.
It's a gold rush of new targets.
Right. So if Silicon Valley succeeds, the intellectual bottleneck of drug discovery will be solved. We will have unlimited ideas.
Yeah.
But the FDA's safety mandates are immovable. Every single algorithmic miracle still requires physical validation in a wet lab.
You still have to prove it works in the real world.
Exactly. So if AI solves the digital bottleneck of discovery, it inevitably shifts the bottleneck entirely into the physical world.
Wow. The constraint will no longer be human ingenuity or finding the right molecule.
No.
The constraint will simply be the finite physical capacity of preclinical testing facilities, the availability of specialized scientific labor, and access to validated animal models.
Precisely. In a future where infinite molecules can be designed in silico, the entities that control the physical laboratories necessary to prove those molecules are safe, they will wield unprecedented power over the future of global medicine.
It fundamentally alters the value proposition of a company like Charles River.
It really does. They become the eye of the needle. Thank you for joining us on this deep dive. Whether you're dissecting these earnings for portfolio strategy or simply seeking to understand the hidden architecture of modern healthcare, we hope this analysis provided a clearer view through the murky waters of corporate finance.
Keep looking past the headlines.
Until next time, keep scrutinizing those underlying mechanisms, and we will see you on the next deep dive.